For much of the last decade, investors operated under a simple, restrictive principle, TINA, or there is no alternative. To achieve any meaningful growth, capital had to flow into the stock market, accepting its inherent volatility. Bonds, on the other hand, offered yields so low they often failed to keep pace with inflation. Holding a safe government bond frequently meant your purchasing power was eroding. The choice was between accepting equity risk or guaranteeing a slow loss in real terms. But that market regime is now over. We are seeing a structural shift in the bond market that is presenting investors with a new set of calculations. For the first time in years, there is a real choice to be made. Yields are now competitive with the earnings yields of stocks, which seems to present a clear opportunity to de-risk. But this is where a significant threat emerges. The advice to simply buy bonds overlooks a critical variable. Depending on the bond you choose, the outcome could be a stable return or a significant capital loss, even with a government-backed security. The central conflict we need to understand is this. The opportunity in the bond market is positioned directly next to a substantial threat. First, let's analyze the opportunity, because it is significant. Bonds are once again a competitive asset class, offering meaningful income. If we look at the data as of late July 2026, the yield on a 10-year U.S. Treasury note is approximately 4.75%. Looking further out on the curve, 30-year Treasury bonds are offering yields above 5%. This changes the structure of a portfolio. It means an investor no longer has to rely exclusively on the unpredictable nature of equities to generate returns. You now have a powerful tool for diversification. When the stock market experiences a drawdown, high-quality bonds can act as a stabilizer, providing a steady income stream and preserving capital. They function as a financial shock absorber. This income is predictable cash flow. For anyone who needs to draw from their portfolio, this is a material change. Instead of being forced to sell equities during a downturn, one can live off the interest payments from their bond allocation. Asset managers are calling this a fixed income reset. It signals a return to a more balanced investing framework, where a portfolio can be constructed with both the growth potential of stocks and a stable income foundation from bonds. This is a real opportunity to reduce portfolio risk while still earning a solid return. This brings us to the hidden threat. An investor sees the available yields and notices that a 30-year bond pays a higher rate than a 2-year bond. The logical inclination might be to lock in that higher rate for a longer period. This is a common and dangerous mistake. What isn't widely understood is a concept called interest rate risk, also known as duration risk. This is the single largest threat to bond investors today. The relationship can be understood by thinking of a bond's price and prevailing market interest rates as being on opposite ends of a seesaw. When new interest rates go up, the price of your existing, lower-rate bond must go down. Let's walk through an example. Imagine you purchase a 30-year bond for $10,000 that pays a 5% coupon. A year later, due to a shift in the economic outlook, the government begins issuing new 30-year bonds that pay 6%. No rational investor would buy your 5% bond at its face value of $10,000 when a new one paying 6% is available. To sell your bond, you would have to offer it at a discount. Its price must fall to a level where its effective yield becomes competitive with the new 6% bonds. The critical point is that the longer a bond's maturity, the more sensitive its price is to these changes. The movement on that seesaw becomes more violent. A 1% rise in interest rates might only slightly affect a 2-year bond's price. However, for a long-term bond, the impact is magnified. To put this in concrete terms, a bond with a long duration, say a 30-year bond with a duration of 18 years, will fall in price by approximately 18% for every 1% parallel increase in interest rates. That represents a $1,800 paper loss on a safe $10,000 investment. The investor is so focused on the yield that they do not see the principal value of their asset declining. Of course, if you hold the bond for the full 30 years, you will receive your original principal. But 3 decades is a significant period. If you are forced to sell that bond in 5 years to fund an expense, You could be locking in a substantial loss on an asset you believed was risk-free. Chasing a slightly higher yield on a long-term bond exposes an investor to a level of risk they are often not aware of. So, how does one capture the opportunity of higher yields without being exposed to this duration risk? The solution is to apply a systematic rule. Match the maturity of the bond to your time horizon. First, you must determine the objective of the capital. The answer dictates the type of bond to use. If the goal is capital preservation and short-term income for funds that may be needed in the next 1 to 5 years, then the allocation should be in short-term bonds. This includes treasury bills or bond funds with an average duration of less than 3 years. The price sensitivity of these bonds is significantly lower. If interest rates rise, the price will dip only slightly. And because the bond matures quickly, you receive your full principal back before the price change becomes a major factor. This is the correct way to make cash productive without taking on unnecessary price risk. If the goal is long-term income or potential price appreciation, then long-term bonds can be considered. But it is critical to understand that this is a different kind of investment. Buying a long-term bond is an active bet that interest rates will remain stable or, ideally, fall. The seesaw mechanism works in both directions. If you own a 30-year bond paying 5% and market rates fall to 4%, your bond becomes highly attractive. Its price will rise, delivering a capital gain in addition to its interest payments. Many professional investors use long-term bonds precisely for this speculative purpose. It is a bet on the future direction of interest rates, not a strategy for safety. For investors who want to access higher yields but avoid making a large bet on the direction of rates, a strategy called a bond ladder can be used. Instead of investing a lump sum of $50,000 into a single 10-year bond, you divide the capital. You might put $10,000 in a 2-year bond, $10,000 in a 4-year, and so on, up to 10 years. Every 2 years, one bond matures, returning your principal. You then reinvest that capital into a new 10-year bond at the end of the ladder. This systematic strategy accomplishes two things. It provides a steady, predictable flow of cash, and it diversifies your interest rate risk across time. You are never fully exposed to a single interest rate environment. If rates rise, you have maturing bonds ready to be reinvested at the new higher rates. If rates fall, you have already locked in higher yields on your longer-dated bonds. A complete analysis requires looking at the macro forces that could keep rates elevated, making long-duration bonds even riskier. There are several factors at play beyond central bank policy. One is the risk of persistent inflation. Supply chain disruptions and geopolitical conflicts can reignite inflation, as we have seen in the past. If the market anticipates inflation will remain structurally higher, it will demand higher yields as compensation. Another factor is large-scale government borrowing. When governments run significant deficits, they must issue more bonds. This increase in supply can push down prices and drive up yields. Finally, global risks, such as instability in the Middle East or shifts in trade, can fuel inflationary pressures and create a volatile environment for fixed income. Understanding these forces reinforces the main takeaway. Be deliberate and cautious with long-term bond exposure. So, are bond markets an opportunity or a threat? The answer is both. They present a significant opportunity to earn government-backed income and add a stabilizing element to a portfolio. The yields available today are attractive, but this opportunity is paired with the threat of interest rate risk, which can inflict large capital losses on investors who are unaware of the mechanics of duration. The key is to stop thinking of bonds as a single asset class and instead focus on maturity. Use short-term bonds for safety and near-term goals. Use long-term bonds only when you are making a deliberate, speculative bet on the direction of interest rates. And for a balanced, systematic approach, a bond ladder can be used to manage risk over time. Do not simply chase the highest yield. Choose the maturity that aligns with your financial objective. That's exactly why we built a systematic macro investment strategy to help investors navigate these kinds of conditions.